Good morning, afternoon, March, Friday the 13th. We're seeing quite a bit of risk off this morning. Nifty, Kospi, Nikkei, all getting hit this morning. ES, NQRTY down roughly 0.5%. Stocks last night, just energy sector was the strongest performing, with the materials sector also up on the equal weight. And obviously, it's all driven by crude going higher. Brent, 80 basis points. WTI, 1.37. Nat gas, 2%. All the metals are down, and dollar is storming higher. Aussie, Kiwi getting hit. Pound and euro also. And yen getting a little bit of a lift as well. Classic risk-off type of moves. CAD, also quite resilient, being a close neighbor of the dollar in this energy-driven risk-off environment. It's looking a little hairy out there. Jobs data continue to be good. We're seeing that seasonal pattern as expected, some upward pressure in unemployment claims going into the year end, and then for that to drop off sharply, as we can see in the non-seasonal adjusted series, the yellow. And the seasonally adjusted series are just basically holding steady. Slight decline in the job initial claims and continuing claims as well. Slight decline. So holding steady. Nothing of note there in terms of concerns that the labor market is cracking. It's not yet doing so. But news sentiment is definitely taking a hit. And this will get reflected in the data eventually if this keeps going, because its sentiment is very much leading. And then, the soft data is considered leading data, and the hard data is obviously very lagging. And if there's any indication, early indication of what those indicators could look like, it's via this index, because that sentiment is already very, very negative, and that's going to start to affect PMIs and economic activity. And you can see that it's very strongly correlated to S&P returns. So, this doesn't bode well for risk assets. We can see here a nice uptick in 2024. That's led S&P returns higher, and then it started to decline, and then S&P kind of followed that lower, and here as well, roughly correlated during 2025, and it's rolling over. Also, efficient market hype also posted this morning. I suspect it might be after he's seen my post. Not sure, but essentially saying the same thing. He's got the soft economic data average and hard economic data average, the blue and the beige khaki color. Well, the blue one, at least, is starting to roll over quite a bit. Quite similar to what we're seeing in the New Sentiment Index, while the harder data is not yet to fall over. U.S. 10-year yields, I'm not sure how I feel about U.S. 10-year yields, but in terms of the S&P, see that on a 6-month basis, it's still relatively strong, and we could, normalize back to something like a flat 6-month performance. In terms of news flow, oil pressures are still quite strong. Some countries are trying to cope with policy measures, special reserves being released. But time is of the essence, isn't it? The key question is how long this conflict goes on for, how long those disruptions in the Strait of Hormuz impacts some major economies. And major economies are closely linked together. Very much reliant on each other. The longer it goes, how long that tension remains in the Middle East, it does not look like the end is in sight yet. Policy measures to offset some of the energy impact. U.S. eases Russian oil sanctions. That's how bad it's got. Something they would otherwise never think of doing, but it's getting desperate. Brent oil above 100 for the first time since August of 2022, which was the height of the initial Ukraine invasion. U.S. gas waivers as traders weigh Middle East conflict against storage. $5 heating oil. Goes without saying, right, that it affects all those other products that come out of crude. Gig workers feel the pain at the pump as gas prices hit 21-month highs. We saw that it hit $3.50 a gallon in the U.S. Crude oil, LNG, you can see the exporters on the left and all the importers on the right. This is everything that comes out of the Strait of Hormuz. And we can see a lot of them goes to these Asian countries and some big, industrially heavy. United States, very, very little. Rest of the world, Europe, very little. But particularly the Asian countries are the most affected by this. And that obviously supports our view that we think that the dollar Asia complex is going to be going higher. Qatar, UAE, for LNG, Qatar, they're the biggest, and you see the effect that it has on Asia as a whole, and Europe. Also been hearing of some disruptions to the European supply. FT front page, same old stuff really. Oil tankers trapped in the Gulf, sitting ducks. Iran still hitting tankers. I think they've hit as much as 3 just over the last couple of days. Dollar hedge ratios kind of shows that U.S. is actually a winner in this type of risk off. So there's some early evidence of that as hedge ratios come down. No one's really concerned about dollar downside at the moment. Another perspective on how sentiment towards the dollar has changed. Netanyahu says Iran regime change not guaranteed after war. There's been some commentary being extrapolated from these comments, and I'm not so sure what to make of them. Iran's new supreme leader, he's saying that the strait should stay closed. Bombing won't overthrow ruling clerics, blah, 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 blah. Drone attacks on a base in Iraq. So, yeah, nothing new there, really. There's some uncertainty about the regime change. It's an article from the Wall Street Journal suggests that there could be a peak in the Israeli campaign. This is all based on that conversation around whether, what Netanyahu's saying, not sure about what happens with the regime change with certainty. If it doesn't fall, it will be much weaker. IDF spokesman was saying that there are more steps at different levels that are beyond the IDF. There was a decision to make the conditions for people to take to the streets. We are not there yet. We know we have Ali that's kind of joined us. We haven't really seen him on very much, so it's been difficult to get a view, but it seems apparent that he's joining protests and things like that, and, if that's a sign of what people are trying to or wishing for and doing, protests and wishing for a return of Pahlavi, then, maybe we aren't that far away, not sure, but that's the direction that everyone seems to want. There's no recipe for this. It's not mechanical engineering. The war is planned to last weeks, and these processes can take years. So, does that change anything? I think they just press on. It's a lingering question. I don't have the answers or even the ideas of where that ends, but Trump, echoing some words that he spoke of many, many years ago, we have to start winning wars again, and now we never win a war. We never win, and we don't fight to win. We don't fight to win. You either got to win or don't fight it at all. Trump warns Iran to watch what happens as war hits 2-week mark. Watch what happens to these deranged scumbags. Doesn't sound like we're anywhere close to an end. Iran has likely begun laying mines. This has not been corroborated by other sources. There has been some mine-laying vessels carrying 2 or 3 big mines on them. There is some supporting reports to at least Iran's intention of doing that. Iran's missile launcher arsenal holds steady, little changed from the 60% reported last week. 2 Western estimates put the number of total destroyed launchers at 60%, with one adding as much as 80%. Anyway, they still have some launchers. We'll have to see how that story develops. Obviously, if that number goes up, we're probably a little bit more closer to the end. Israel at Beirut, Hezbollah signals long campaign. Iran's Shiite allies step up strikes despite weakened hand. Axis of resistance suffered heavy blows after Hamas attack. Hezbollah executes Iranian plan in case of war. Iran's new leader thanks resistance front fighters. And then this military rebel group could join the Iran war next against the U.S. Any guesses which military rebel group this is? It is, of course, the Houthis. They have, historically caused a ton of a nuisance with reasonably good success with very little, to be fair. Still a lot of risk to consider. We're seeing reports of more attacks. We're also seeing reports of more attempted attacks on energy infrastructure. U.S. to ease shipping rule in bid to tame swirling prices. So more policy stuff. Trump saying it's not appropriate for Iran to be in the Soccer World Cup, et cetera, et cetera. Okay. In terms of the impact, there's a nice article here by David Cervantes under the name of Pinebrook Capital. And he's pretty good. Makes a lot of good macro type of calls. Just to skim through it, we're seeing increasing spot inflation mixed with lower aggregate demand, and it brings back 2022 vibes. And if you remember 2022, that was the start of a recession. It wasn't declared a recession, but it was a technical recession. We had two back-to-back quarters of which he talks about here, in fact. Back-to-back quarters of negative GDP growth in 2022. And we saw a bear market in the S&P, right, for quite some time. And we could see something of that nature. The longer this oil supply shock keeps going, energy prices are high, and that impacts economic activity in every single way possible. Basically, stagflation, right? But from a trading perspective, I have argued that the stagflation risk of the U.S. is far lower for others. So that's particularly relevant for which assets do benefit, and that's the dollar. So still sticking with that. Still short on the risk complex. Hope you guys are benefiting from those, the short risk and long dollar type of book. How it could look in Q1 as we're approaching the end of Q1. Well, another couple of weeks to go. But we get some weak retail sales, a softer March sentiment reversal in new orders and services employment, which have been very, very strong. All of these things could now start to feed into this overall lower growth or flat to negative growth. Writing off Q2 GDP as zero and potentially negative, a potential recession in Q2. And if we get that in Q3 as well, then that would be considered a technical recession of some sorts. This is all an opportunity, as bad as it sounds, and I completely agree with this whole thing. This is not a situation where risk assets perform well, quite simply. In fact, it's one of the worst. In a slowdown, tech stocks could save you. But in a stagflation, tech stocks won't save you and nothing will save you because even bonds won't save you. So you don't get that stock bond rotation either. Because you have prices going up, yields are going up. These aren't the times to really kind of hide in bonds, because if yields are going up, those bond prices are going down. If yields are going up, the valuations to tech stocks goes down. So there isn't a place to hide. In a normal slowdown, there is bonds and tech stocks, with tech stocks being considered duration assets, as it's been called every once in a while. But stagflation is just the worst. You have policy tightening at the expense of growth, because you can't let stagflation, inflation get out of control. So you have to keep it relatively tight, even if you don't tighten. You keep things steady, expecting that it's going to be that T word again, transitory. And eventually, these sorts of risks are but in the short term, it could be quite painful, slowing growth. In terms of the risk assessment now, I think he's right on the money, and it's basically the angle that I've been taking, except he just goes into a lot of more detail, puts it into good context as well. This being very, very much 2022 vibes, and then we look at the S&P.